So something that is commonly discussed with all my clients that I prepare their tax returns for is their interest that they pay on their primary residence. How much of a benefit do they receive from taking this deduction? And one of the most common questions that I've gotten is, hey, I paid X amount of interest over the year, let's just call it $50,000. Why did you only put $40,000 as a tax deduction on my Schedule A? The first thing you need to know, whenever it comes to your primary residence, you can only itemize the mortgage interest and the real estate taxes that you pay on that property. Now, if you have a secondary property, you can also take the mortgage interest on that, but there's another limitation on mortgage interest itself. And remember, this is just for your primary and maybe secondary homes. This does not apply to your rental properties. Now, the limitation on your primary mortgage interest is you can only deduct mortgage interest on the first $750,000 of mortgage debt. So an example of this, let's just say you have $1 million home and you pay $50,000 of mortgage interest over the year. In this example, you have total mortgage debt of $1 million, but you can only deduct interest on the first $750,000. So you take $750K divided by $1 million and you get 75%. And if you paid $50,000 in mortgage interest in the year, you take that 75% and you multiply it by the $50,000. So in this example, you would just take the $50,000 of interest that you paid over the year, multiply by that 75%, and that gets you around $37,500. And that would be your mortgage interest deduction on your Schedule A. Now remember, it only makes sense for you to itemize or take deductions on your Schedule A if they exceed the standard deduction.